Hello everyone, welcome again. We are still at value-added tax as we have concluded our value-added tax in the previous video lecture. I told you that we will look at a past exam paper which is relevant to a capital goods scheme. So we will look at that question in this video. Just give me 1 second while I open up the notes as well on the relevant page. So that is page number 98. Sorry, 97. Page number 97 of your lecture notes. Please keep your notes in front of you while we will attempt this question. That is a question number 26 of your BPP exam kit. If you open up your question number 26 of your BPP exam kit as well, that is, we are only doing a small part of it, which is Madison Limited, M-A-D-I-S-O-N, Madison. So Madison Limited, it's a huge question, 25 mark question, but we're only going to do it the small part of it, which is Madison Limited. That part is only relevant for a capital goods scheme of value tax. Now this question, which is Bond Limited, it was examined in June 2014 exam. Now at that time there were different rules and different rates of tax as well. However, the exam kit has amended it for us, so it's the new rules which we will study now. Now, just read the requirement for now, please. It's part C of the question, which is worth 5 marks. Let me share the question with you through the screen share option. Now, I'm just sharing the question through the screen share option just to make your life a little easier. But please make sure you keep the exam kit in front of you always. That's why in the first lecture I told you to buy the exam kit. If you haven't bought your exam kit yet, I can't help you. So if you come to page number, I don't know what's the page number, but question number 26, and that's part C which we are going to do, Madison Limited. It says recovery of input tax. That's 5 mark question. Now the information is given to us in the email from your manager. If you see email from your manager, and in part C, Madison Limited, recovery of input tax. Explain how much of the input tax in respect of the purchase of the building and machinery can be recovered. Now there are 2 things which were purchased. One is building and other one is machinery. Now we have studied in the capital goods scheme, we have studied that there is a rule for the land and building, and then there is a rule for computers as well, and there are different amount threshold, £250,000 over £250,000, and it says that computer, boat and aircraft costing £50,000 or more, so that is £50,000 for the computer and £250,000 for land and building. Alright, so if it exceeds £250,000 for land and building, and if it exceeds £50,000 for the computer, boat and aircraft, then capital goods scheme will be available, which means that we have purchased that, then we will not be able to recover the whole amount in the current year. We will be able to claim in the first year basically, but in the future year we will have to see that how much is our recovery percentage, how much is our use of that asset for business purposes, and according to that we will be able to either repay to HM Revenue and Customs if we have overclaimed it, or we will claim from HM Revenue and Customs if we have underclaimed it. Right? Now I would go to the question again. Now it says explain how much of the input tax in respect of the purchase of the building and machinery. Now we have studied the rule for building, so it will come under the capital goods scheme. However, machinery will not come under the capital goods scheme. So for machinery we will just recover it once for 1 year. There won't be any more adjustments after that. And machinery can be recovered by Madison Limited in the year ended 30th of September 2019. So he's asking us to calculate for the year ended 30th of September 2019. And how this may be adjusted in the future years. As I said, in the future years we will make the adjustment. So we'll take the percentage in the first year less the percentage in that year, and multiply by 1 over 10 or 1 over 5, depending on what it is. Include an example of possible adjustment in the year ended 30th of September 2020. Now it is asking us to do an assumption as well for the coming year. So we will do not only for 30th September 2019, we will also make an example, and we'll do for 30th of September 2020 as well. Now just above that, just before the email from your manager, Madison Limited information is given. So Madison Limited purchased a building for £400,000 plus 20% VAT and machinery for £300,000 plus 20% VAT, began to trade on 1st of October 2018. So this is the information: £400,000 for the building, and the £300,000 for machinery. And Madison Limited is partially exempt for the purposes of VAT. In the year ended 30th September 2019, its VAT recovery percentage is expected to be 80%. So that is a percentage which we will be using, because that is our current percentage. However, it says that I expect this percentage to fall slightly in the future years. So in the future years it might fall, but for now that is our current percentage, right? Now when we will take the next year's assumption, which is, it says do for the next year as well, 30th September 2020, we will make this into consideration as well. We will consider this information, that it says that in the future it will fall slightly. This percentage will fall slightly in the future years. So in current year it's 80%. So in the future year, which we will be making the assumption, the example of 30th September 2020, we will be taking as 70% or 60% or whatever. So we will take the reduced rate of recovery, right? So let's do this question then. Just bear me 1 second while I cancel the share screen. 30th of September 2019, building, so first of all the building, and we have purchased it for £400,000, and times the VAT rate is 20%, times the recovery rate in the current year is 80%. So 20% of that is going to be £80,000, and then 80% of that is going to be £64,000. So I'll take £64,000. So that is the recovery in the year ended 30th of September 2019, right? Now in the coming year, which is 30th of September 2020, we have to make the example of that. That's 30th of September 2020. So 30th of September 2020. Now in the coming year, we will make an assumption that it will reduce. This recovery percentage will reduce. Then what would happen? Times 80%, which is a percentage in the first year, less percentage in the current year. So I'm making an assumption that in the second year it would be 70%. So I'm just making an assumption that it would be 70% in the second year, and times 1/10, right? And because it is a building, so I'll take it 1/10. Because for land and building, we will take it over the 10 VAT years, right? So we'll have to do the calculation for that. So 20% of that would be how much? £80,000, and then 1% of that would be £800. That would be £800, I think so. Let me do it on the calculator as well, just to make sure. And divided by 10. Yeah, that is £800. So that would be recovery in the £800 in the second year, 30th of September 2020. So the first year was the £64,000 it was in the first year, which we have already recovered. Now because in the second year the recovery percentage has reduced from 80 to 70%. So of course, because in the first year we have recovered more, we should have recovered less. Now because in the second year the percentage is 70%, so this is the amount which will be payable to HM Revenue and Customs. So we will repay to HM Revenue and Customs. We have overclaimed it. Now why we are doing this treatment? Because it is a capital goods scheme. Capital goods scheme. If we look at the machinery, the capital goods scheme will not apply on the machinery, because we haven't studied any rule for machinery. So whatever the price of machinery is, let me just see the cost of machinery. So for machinery, we have purchased it for £300,000. So that was for building. That was for building. And now if we look at the machinery, so for machinery we will do just one thing, one single year. So £300,000 times 20% times 80% is the recovery rate. So that's going to be how much? 6,000 times 80% 4,800 pounds. Let me do it on the calculator again, just to make sure. So 300,000 pounds times 20% times 80%. Sorry, 48,000 pounds. £48,000. Now this is the percentage of recovery in the current year, which is the year 30th of September 2019, and we will not make any adjustment in the future years because a capital goods scheme does not apply on this one, and we'll have to communicate this to examiner. So capital goods scheme, just write down capital goods scheme does not apply on machinery, hence no future adjustments. Hence no future adjustments are required. All right, so if you want to just note down this thing which I've just written on the board, please make sure you do now. So for building, capital goods scheme will apply on the building, we know that, whereas for machinery, capital goods scheme will not apply on the machinery, because we haven't studied any rule for machinery of capital goods scheme. When capital goods scheme apply on the building, it will be recovered over the 10 VAT periods, and it depending on in the future periods, if the recovery percentage of VAT is increased or decreased, we will either have to repay to HM Revenue Customs what we have already recovered, or we will have to claim from HM Revenue Customs if we have underclaimed from HM Revenue Customs. All right, and for machinery, because it is the capital goods scheme does not apply on the machinery, so we'll just take it the straight current recovery percentage in the current year, and we will apply this that straight amount, and in the future years there will be any adjustment. Right? Right, then now that's it for this video lecture, and that's it for our value tax as well, and we have finished our almost all of the syllabus. In the next video we will be it will be a concluding syllabus video. So in the next video we'll be giving you some questions which you must do, and some exam tips as well, which are relevant to ACCA P6 taxation. So next video is a must-watch video, which I will focus on the exam tips specifically and the questions which you must do. However, because for now we have finished value tax portion, so the questions which are must do for you, if you want to note down these questions, please just grab a pen and a piece of paper where you can write down the questions which you must do after finishing the value tax. So because now you have finished the value tax, these are the questions which you can do. Question 10 part B, it is with regards to VAT registration. Question 16 part D, that is pre-registration input VAT. Question 27 part C, that is also with regards to VAT registration. Question 28 part A, with regards to flat rate scheme. Question 29 part C, VAT group registration. Question 31 part C, that is a registration of value tax again. Question 34 part A, that is partial exemption. And question 35 part C, that is de minimis test. Alright, along with this question as well, which we have just done, that is question number 26, which I haven't told you in this list. So you must do this question as well again. After redoing this question, then you will do these questions which I've just told you. So it will almost test you all the knowledge about the value tax. Alright, so these are the must do questions. And again, these questions which I've just told you, these are the questions from BPP exam kit. So I haven't told you the names of the questions, but if you just grab the BPP exam kit, the current version, so these are the questions which you must do. Alright, so I will see you in the next video, where we will be looking at the ACCA P6 Advanced Taxation exam tips, how to attempt the exam, what are the most common mistakes, what the examiner expects, and all that. I will see you in the next video then. Goodbye.